Welcome back. Our final presentation for today is titled Top 10 Tax Planning Ideas in 2022 for Physicians, sponsored by Physician Tax Solutions. We will have some time after the presentation to answer the audience's questions. If you have a question about the topic, click on the Ask a Question button on the left side of your screen, type in your question, and click Submit. So let's introduce our presenter and get started. David Auer is the owner and founder of Physician Tax Solutions. With more than 35 years of experience as a certified public accountant, speaker, best-selling author, business consultant, and entrepreneur, David Auer is the founder and Provident CPAs, is the founder of Provident CPAs and Physician Tax Solutions. David earned his BSBA and MS in accounting from Oklahoma State University, his JD degree with honors from Oklahoma University College of Law, and his LLM in taxation from New York University School of Law. He has the personal financial specialist and chartered global management accountant designations with the American Institute of CPAs and is a certified tax planner with the American Institute of Certified Tax Planners. David is recognized as one of America's premier experts and is on the adjunct faculty of Asset Protection Corporation, founded by internationally acclaimed asset protection attorney Robert Lambert. As a leading expert, David has been seen or featured on ABC, CBS, NBC, Fox, Fox News, Forbes, CNBC, and MSNBC, and Medical Economics. Throughout his career, David has provided his expertise to several written works, is a member of the National Academy of Best-Selling Authors, and is the author or co-author of several national best-selling books. David, take it away.
Well, thanks, Chris. So welcome, everyone. I first want to give you somewhat of an overview of what I'd like to share with you today. I've got as many as 50 slides to go through, so it'll just be ready to drink from the fire hose. I would like to mention or follow up with what Chris said, that my latest book that just came out about 2 months ago, it's my first fiction I've ever written. It's called The Richest Doctor. It's a modern parable of financial independence. So it's a story of 4 physicians who meet about 5 years out of residency. They decide, or they are discussing about how much tax they're paying and how little farther ahead they are financially compared to what they thought they'd be when they were residents. Anyway, it's been out for about 2 months. It's already an Amazon bestseller. I'll give you a little bit more information later if you'd be interested in reading it, which I think you'd find a lot of valuable information. So a little bit about Physician Tax Solutions. So we are a proactive tax planning firm. We also provide all of the traditional support that you might see in a CPA firm, including the accounting and the tax compliance. But we focus most of our efforts on the proactive tax planning that high-income professionals such as physicians are struggling with and need assistance with. So before I get into the material, just want to give you a brief disclaimer. Nothing that we're going to talk about today is intended to expose someone to penalties under the Internal Revenue Code or promote any particular products or concepts. So obviously, when you enter in, start doing tax planning, it's very important to work with an experienced team of professionals, not just someone who's going to put the numbers on a tax return and go on down the road. So what I'd like to do before I jump into the recommendations is turn the slides here. So there we go. Just first give you a high level overview of what changes have happened so far this year compared to last year. So if we look at, Chris, I'm having a little bit of difficulty advancing my slide.
Let me see.
David, go ahead and refresh your browser.
All right. Perfect. Sorry about that, everyone. So the first thing I want to just review here, just so for everyone's information, these are the 2022 tax rates that are for single, married, filing joint, and heads of household. So we're the target range is for most physicians or high income professionals is going to be starting at the where you're starting at the low end, possibly the 24% rate, but for the bell curve probably quickly rising to the to where most people are going to be in the 35, possibly 37% rate. So you can see there where the dollar break points are. The reason I bring this up is in most tax planning, it's very important that you know what tax bracket you're in and how much runway you have until you bump into the next higher bracket, especially if you're going to be doing some of the strategies that we're going to talk about here today. So just make sure you know what tax bracket or range you're going to be in, so that you know the range of what the dollars are that you're talking about saving, or if you're trying to do something, which I'll talk about it here in a little bit, such as a Roth conversion, you know what the ceiling is that you may want to stay under. So those are the individual brackets. Refresh my screen again. So Chris, I'm having the same difficulty and I tried refreshing. Oh, here it is. Okay. So also the tax rates for corporations, if you happen to have what is called a C corporation or a taxable corporation, that rate is a flat 21%. There was a proposal in Congress last year to lower that down to 18%, up to about $400,000 of taxable income. That actually would have been a benefit to a lot of our corporate clients who have C corporations, but that didn't happen yet. And if you remember back 4 years ago, prior to 2018, the lowest corporate tax rate was 15%, and then it graduated up from there. As many of you are well aware, we also have another paradigm of taxes called Social Security and Medicare taxes. It's a 12.4% rate if you're self-employed, up to the wage base in 2022 of $159,177. If you're an employee, that ceiling or that top wage base is $147,000. Everything above that, whether it's self-employed or if it's self-employed or if you're an employee and you're just responsible for your half, is either 2.9 or one or half of that. And then if you have a W-2 or self-employment income above 200,000 if you're single, 250,000 if you're married filing joint, you're also hit with another tax called a Medicare surtax of 0.9%. So moving on to the next slide. I apologize. Here we go. So
I can advance the slides for you. Just tell me next slide when you're ready.
Oh, perfect. Let's do that. So what I have here are what the long-term capital gain rates are. As you may or may not know, the capital gains tax rates are synchronized, or they're a correlation with what your marginal ordinary income tax bracket is. So the higher your taxable income goes, the higher your capital gain rate goes. At the lowest, it could be 0% if you have under a certain amount of income. And unless you're in the very top bracket of 37%, that tax rate is 15% before it then jumps up to 20%. An unfriendly reminder of when you have a significant amount of capital gains is you might also then be subject to another tax called a net investment income tax of 3.8%. So if your net investment income is over 200,000, if you're single or file-headed household, you get hit with that tax. If you're married filing joint, you have net investment income of over 250,000, and that tax kicks in. So you can see very easily how these all these various taxes, depending on your level of income, just start laddering and adding to one another. And like I'll mention here in a few slides, when you add state income tax on top of that, it puts especially the higher income taxpayers or professionals in a very high tax bracket where it's not uncommon to see 50 to 55 cents on the dollar above a certain level going to the government, and the rest is what you get to keep. So Chris, we'll go one more slide. And then if you'll back up one, sorry. The standard deduction for 2022, married filing joint is $25,900. Head of household is $19,400. Single is about 1/2 of the married filing joint. I'll talk a little bit about the single tax or standard deduction, especially when you are in a situation where you could perhaps shift income to a family member, such as a child that could be in a much lower tax bracket than you. Health savings accounts this year, they jumped up $100 or $200 to where a family has they can contribute up to $7,300. If you're 55 years or older, that adds an extra $1,000. Next slide. And as far as retirement plans, what the contribution levels for 2022 are, the IRA contribution amount stayed the same, 60,000 up to age 50. You get an extra 1,000 catch up if you're age 50 or older. If you are interested in deducting an individual retirement account, those IRA deductions start phasing out at certain levels, depending on if you or your spouse are participants in an employer provided plan. And you can see what those amounts are. And then the phase out, which a lot of you are also subject to, interested in doing a Roth IRA, that the ability to fund a Roth IRA phases out at certain income levels completely at $144,000 if you're single, $214,000 if you're married filing joint. I'll talk a little bit in a future slide about one way to get around that, which is a backdoor Roth IRA. Next slide. And when depending on what type of retirement plan you have or what you might be eligible to consider, ranges from a self-employed plan to a simple IRA. You might also have or be interested in a 401k or a profit sharing plan. And then the last one generally is going to be a defined benefit plan. Depending on who your employer is, whether it's a for-profit or not for-profit, 401k and the profit sharing plan may be defined, under other code sections. So 403B, for example, or a 457 plan. What I have here is listed here is the maximum employee contribution that an employee can make under each of those plans, and then what the maximum employer contribution could be made in each of those plans. So probably important to note that SEP plans, generally there is no catch-up contribution if you're age 50 or older, unlike with profit sharing plans. And with 401k plans. Let's move to the next slide. And what I have here on the next slide is what the current state income tax rates are. So when you are adding up what your marginal tax bracket is, you'll want to definitely take into account what your state income tax bracket is so that you'll get a truer sense of what your marginal tax rate is for purposes of tax planning. So you can see here we have several states that don't have an income tax. And then we have some of the the dark red states are the ones that have the highest tax rates. So definitely include your state income tax. So I'm going to talk about a tax planning strategy involving state income tax if you're eligible by having a pass-through business entity that you could elect. You can make an election where you're not limited by the typical $10,000 itemized deduction ceiling that currently is in existence. I'll talk a little bit more about that in a few slides. When we look at the next slide, what I also have an overlay here is what the current corporate tax rates are for each state. So Chris, one more slide. There we go. And so if you're a C corporation or contemplating having a C corporation, either for your primary business and or your as an ancillary business or a side business, then you need to add the 21% federal rate on top of whatever the corporate state income tax rate is. So that's basically where we are for 2022. Chris, if you'll turn to the next slide. What I'd like to do before I jump into the recommendations is to go over what is currently on the plate of the president in his 2022 budget. A lot of these are carryovers from last year when Congress was contemplating several versions of a Build Back Better legislation. But this is what has remained in terms of President Biden's 2022 budget. The likelihood of this becoming law this year is starting to narrow. Generally, Congress takes a recess starting Labor Day. So we only have a couple of months left before possible legislation could get considered. And then really it's a wild card to guess what will happen after the November elections. If there's a blue wave or a red wave swing, then things will either speed up and or come to a halt. But just naming a couple of these proposed changes, just so you can at least understand what possible changes could be out there. One would be changing the top individual rate from the 37 to the 39.6% bracket. It's going to actually feed into the 32% current bracket. So for some people who are in a 32% bracket, it's going to be a little bit over a 7% jump in their federal rate. Long-term capital gains, if your taxable income is over $1 million, will go from the top rate now 20% up to 39.6%. There will no longer be an adjustment to the cost basis of appreciated property at death. So in other words, your heirs would inherit whatever the tax basis was of the that you had in that property. So they would then have to pay capital gains tax on that, all of that appreciation that happened during your lifetime, as well as up to the point that they sell that property. There's also another new tax that President Biden is contemplating. It's called a minimum income tax. It would be on a taxpayer with over $100 million net worth on any unrealized gains and the tax rate would be 20%. Like-kind exchanges would go out the window. So right now they've narrowed it down to where it just applies to real estate. But the deferral of gain on 1031 exchanges would go away and or be significantly reduced. There's talk of an exemption up to $500,000 of gain. There'd be, for those of you who have heard about or contemplated investing in syndicated conservation easements, those will be made much less attractive because of a limited deduction that is being proposed. And then the C corporation tax rate would jump from 21% up to 28%. So it's currently at the 21% rate. So what is the likelihood of the tax rates going up in the future? I think most of us would all agree that with the amount of spending and debt that we have, that tax rates at some point are going to have to start trending up. Chris, if you'll turn the slide, I have a slide here that shows what is the history of our marginal tax bracket for the highest income tax bracket ever since it became, ever since we had a tax going back to 1913. So as you can see, going way back to the beginning, it was only a top tax rate of 7% for the highest income earners in the United States. And then as you'll also see, as we entered into World War I and then subsequently entered into World War II, the highest marginal tax bracket started jumping quite significantly. So in the 1940s, it ranged from 81.1% to 94%. And then from 48 to 63, it hovered there in the 80 to 90% range, and then dropped just a little bit from 1964 to 1981. So for those of you who may remember back when when we were in the early 80s, when the highest marginal rates were still above the 60% range, would realize how possible it is for us to return to those that time period. So, but as a general rule, in the past, most tax increases happened around wartime in allowing the country to finance the cost of that war. It has been only through legislative power that that they have been able to keep the marginal tax rates relatively minimal ever since about the mid 80s. As you can see, moving into this year, depending on what happens in Congress, that 37% could go back to 39.6%. But what you don't see on this page is all the other taxes that Congress has also created, have also created over the last several decades, such as the ones I mentioned with the FICA and Medicare tax or self-employment tax, depending on if you're self-employed, the Medicare surtax, as well as the net investment income tax. And most states obviously didn't have the high rates that they have now. So overall, when you add all of the taxes up, saying that you're only the top tax rate overall is only 37% is very misleading. That only applies in the limited example of what the federal individual income tax rate is, not all the other taxes that may apply. So, Chris, if you'll move one more slide, as you can see, the likelihood of a tax increase, I doubt it'll ever get to 94% again, but depending on what state you live in and what other taxes you might be subject to, it could very easily be in the 60 or 70% range. And that becomes very important when it comes down to tax planning, because one of the things that we want to make sure we do is not kick the can down the road where we're saving tax today at a 30 to 40% rate, and we're now going to have to pay tax at a higher rate in the future on that income. So very careful, very important to make sure that you're not just pushing the misery of paying taxes, down into the future where you're going to have a higher tax rate. Another factor to look in terms of what the likelihood of a tax increase would be, Chris, if you'll turn the page, what I have here is tracking what the federal deficit has been over the last couple of decades. As you can see, as a result of COVID, we now are running a record deficit both for the last 2 years, possibly going to be doing that again this year. So at some point, this is going to start catching up. And so tax planning, again, becomes increasingly more and more important whenever you're dealing with the possibility of increasing tax rates in the future, as far as affecting future, current decisions as well as future decisions. So with that background, I'd like to then now move into what are at least 10 recommendations for high-income physicians to be aware of. Again, my recommendation is to sit down and talk to your tax advisor. If you have one that was working with you proactively throughout the year. If not, there's that's certainly something that we'd love to have the opportunity to talk to you about. So on the next slide, I'll start with my first tip, which is you'll make sure that you, to the extent that you are in a very high tax bracket now, and it's very important for you to reduce your taxable income. What I have here is the various types of contributions depending on what type of plan. So an individual would have if they were 50 years old and they had a $400,000 salary. So if they had a simple IRA plan, they could put in $26,100 in 2022. A SEP, they could contribute $61,000. A little bit more with a 401k and a profit sharing plan that goes up to $57,500. And again, that's because of the catch-up provision that a profit sharing and a 401k plan have that a SEP does not have. If a defined benefit plan makes sense, there's pros and cons between each of these plans, but probably a few more cons, or at least things to be aware of if you do go down the path of a defined benefit plan. But in the case of a 50-year-old individual with a $400,000 salary, that would calculate out at about $181,600. There are some variations that you can do in the plan design that would get that number even higher than that. And then if you combine the defined benefit plan with the 401k, that would be a whopping $226,000 contribution. And again, depending on what your view of future tax rate is, rates are, these are, you may or may not, it may not be the best strategy to put as much as you can into a retirement plan, especially if it drops you down into a much lower tax bracket in the current year because of the diminishing utility that you're going to get from that deduction. The next tip on the next slide is one that I want to go into a little bit of detail on, and the reason for that is we are now in a window with this recession that we're potentially moving into with the stock market, the way it's decreased over the past several months. Right now, I would say one of the #1 tax planning strategies that most high-income professionals should look at is whether it makes sense to convert some of your tax-deferred retirement account, to the extent you're eligible, into a Roth IRA. So a Roth IRA, for those of you who don't know what that is, that's merely just a transfer from a traditional retirement account or a qualified plan where the money went in tax-deferred into a Roth IRA. There are some requirements you have to meet in order to do that. I'll go over some of those here. So who can do a Roth conversion? Anyone who owns a traditional IRA can make a Roth conversion. If you have a SEP or a simple, after you've had that plan in place for 2 years, you're eligible to do a Roth conversion. And then if you are a participant in a 401k, 403b, or another qualified plan, but only if that plan, to the extent that you still work for that employer, only if that retirement plan allows you to take what is described as an in-service distribution. That is basically a distribution from that plan while you're still an employee. If it's a retirement plan, if it's one of those plans from a former employer, you can always then convert that into a Roth IRA, over to a Roth IRA. A couple of concepts to keep in mind, or additional concepts. Chris, on the next slide, I talk a little bit more about these concepts. Anything you take out of the IRA during the calendar year basically counts as a conversion for that year. So if you fall under the 60-day rollover rule, you could take money out on December 31st, and even though you don't put that money in a Roth until January of the next year, it still counts as a Roth conversion for the prior year. Depending on what your marginal tax bracket is, and especially if you engage in proactive tax planning, whereby you can somewhat control your marginal tax bracket, you might also look at doing a Roth conversion over a series of years where you can mitigate taxes up to certain tax brackets. I'll show you a graph here that may help better explain that. And then if you're a spouse that inherits an IRA from a deceased spouse, you can roll that into your own IRA and then convert it. Unfortunately, if you're an IRA beneficiary of a traditional IRA and you were not a spouse, those individuals are not eligible to be able to do a Roth conversion. If we continue on with the next slide, some of the other factors you want to make sure you take into account is, first of all, that taxes are going to be due on that Roth conversion. So you want to make sure you budget for that. You can certainly use some of the Roth money to pay the tax, although that diminishes now what you are able to roll over or ultimately put into your Roth. So if you have money from other sources to pay the tax, then it allows you to then maximize what that amount is. About 10 years ago or several years ago, we had an ability to unwind Roth conversions after the fact for a period of time. That no longer is possible. And then keep in mind, especially if you want to take advantage of this depressed stock market, then doing a conversion when the market is down and letting all of that future growth happen in now on the watch of a tax-free Roth IRA may also be a good decision. And then just be mindful that depending on what the estate tax exemption is, it's scheduled to go back down in 2026. Depending on what the value of your taxable estate is, just be mindful that Roth IRAs are going to be included in your taxable estate at death. A couple more concepts on the following slide that I just want to cover before we move to the next tip. Obviously with Roth IRAs, the goal is to be able to have that money available to be distributed tax-free. A couple of requirements have to be met. One is that you had to have a Roth IRA in existence for at least 5 years. It's not necessarily that the most recent year you did a conversion or funded a Roth IRA that you need waiting period of 5 years on that. But it needs to be 5 years and older than age 59 and a half, unless you meet one of the early withdrawal exceptions to the 10% penalty. One of the benefits that Roth IRAs have once you do the conversion is they are not subject to the required minimum distributions, which other traditional IRAs and or qualified plans are. So right now, that starting date is age 72 for required minimum distribution. So if you have enough time to convert slowly from your qualified plan over, or your IRA over to Roth over several years, it may also reduce the amount of required minimum distributions. Ever since we had the Secure Act a year and a half ago, we now have a 10-year payout rule that also applies to Roth IRAs, meaning that other than a spouse that inherits a Roth, any non-spouse beneficiary has to take that the entire Roth IRA out over at least within 10 years. So they but on the one hand, it's tax-free to them, but it doesn't allow you to have a perpetual ability to continue to allow that IRA to grow tax-free in the beneficiary's hands. And then on the next slide, what I do here is or just listed several questions to ask yourself or to have someone help you answer. Obviously, to make whether or not a Roth IRA conversion makes sense. One would be, when is this the money that you're converting to the Roth be needed? the longer that money stays in the Roth and continues to grow, the better a Roth conversion makes sense. Another factor is determining who the beneficiaries are. So whether it's a surviving spouse and or children and or perhaps a trust for the benefit of that next generation, which is, by the way, another way to get around the 10-year requirement that the money, the Roth IRA has to come to the beneficiary. If the beneficiary is a trust, that money it comes out of the Roth IRA within that 10 years, but it can stay in the trust for however long the trust allows it to be held. So it allows you to sprinkle that Roth IRA out, or the money from the Roth IRA out, over additional years if you use it in conjunction with a trust. Another important decision, like I mentioned earlier, is what do you think the future tax rates are going to be while you're retired? So that is going to be a function of how much other taxable income you're going to have during retirement. We always recommend that our clients have multiple buckets to draw from in retirement. One bucket being whatever you've already paid income tax on that's now invested, so that you might only have to pay capital gains tax when you sell and need that money to live on. You have ordinary income during retirement, which for the most part is going to be any kind of a side income you have, or taking money out of a traditional or a qualified retirement plan. And then you have a tax-free bucket. So the type of investments typically that you'll have there are what you've accumulated inside of a Roth 401k or a Roth IRA, or could be cash value that you might have built up in an insurance policy. Another important question is how much future appreciation can be expected. So the more appreciation that happens under the inside of the Roth IRA, the better a Roth conversion now makes sense. And that's why I mentioned, now that the market is down, this may be an excellent time to consider pushing that depressed value of that asset over to where the appreciation happens inside of the Roth. And then another question is to find out is make sure you know what the tax on that conversion is going to be. So there's a calculation that needs to be made when you do tax planning to decide how much makes sense for you to take out from your traditional and convert over, so that you can manage your tax bracket and not necessarily pay the highest marginal bracket. And then to the extent that you have outside money, another important consideration is will you need to use the Roth conversion to pay the tax on that conversion, or do you have other money that you can pay the tax and therefore allow the maximum amount or the 100% of that conversion to now be to go into that Roth? And then whether or not you're subject to required minimum distributions and or want to minimize that if you've got other investments that you can live on during retirement. The required minimum distribution could unnecessarily push you into a higher tax bracket after the age of 72 that you otherwise wouldn't need that money to live on. So that's another factor to consider whether you to do a Roth. So I'm going to fast forward over a couple of slides here. I just continue over the next few slides on pros and cons to do a conversion. A lot of these are just in a little bit more detail, but for the sake of time, and I want to make sure we leave enough time for questions, let's go to the next tip, which should be here in a handful of slides. And oh, there it is. So that on the previous slide, Chris. I have here considering, depending on your marginal tax bracket and how much other tax planning you're able to do to drop your tax rate in the current year down to an acceptable level. So a lot of people's mind that's down, at or around the 24% marginal bracket. And keep in mind, for a married filing joint return, that's taxable income of about $340,000 after all of your adjustments to income as well as your itemized deduction. But if your goal is to pack as much as you can into a Roth IRA, and if you're over the limitation to directly fund a Roth IRA, what you may want to consider, if you haven't already done so, is to fund a backdoor Roth IRA. All that is basically you're funding a traditional IRA first, and then you're immediately rolling that or converting that over to a Roth IRA. So your traditional IRA contribution would be with after-tax dollars, so you're not deducting that traditional IRA, and then you're immediately rolling it over to the Roth IRA. Another, a larger scale of funding a Roth is doing what is commonly referred to as a mega Roth 401k. So all that basically is a profit sharing plan added on top of your Roth 401k. So the Roth 401k, you can put the $20,500 in, or the extra $6,500 if you're 50 or older. You fund a Roth IRA, so either 6 or 7,000, followed by the Roth 401k, and then you fund a profit sharing plan contribution, which you then, to the extent that in the plan document, you're allowed to take distributions in service. Once you make that profit sharing contribution, then you immediately roll that over to a Roth IRA. So as a result of that, you can add up those numbers. So you basically are putting close to $67,000, in essence, into your Roth 401k or Roth IRA. So that's another something else to consider doing this year, in addition to doing Roth conversions. Another recommendation, it deals more with investment planning. So Chris, on the next slide, I just have this labeled investment planning, but on the one that follows, this also coincides with having the down stock market that we have. So if you're sitting on investments, and these are not investments inside your retirement account, these are other investments that you've made outside of retirement account, or your retirement account, that would otherwise get long-term capital loss treatment if you sold at a loss, or long-term capital gain treatment if you were to sell it at a gain. So that could be real estate, it could be a stock portfolio, it could be cryptocurrency, it could be any number of other investments that are allowed to be treated under the capital gain rules. One of the ways to think about this is basically being able to bank whatever that loss of value is in that current investment. And assuming that this is an investment that you otherwise would have wanted to hold on to long-term, you just need to be aware of what the capital loss wash rules are, meaning that you can't buy that investment or that exact type of investment back within 30 days after you sell it. So as long as you're willing to ride out the 30 days and or invest in something that's not, or especially if you're going to invest in something that is exactly like what you just sold, just wait the extra the 30 days to buy it back, hopefully at or below the price that you sold it at. Now what that allows you to do is you now have a capital loss that you can bank again and use against any other capital gain income that you might have in the current year. But capital losses carry over in perpetuity for the life of the taxpayer. So it's basically like banking a loss that someday, when you do have other capital gains, you can start harvesting that loss carryover against those future years' capital gains. And to the extent that you don't have those capital gains, or in the meantime, you also get to write off $3,000 a year, which is not a big write-off, but at least you're getting something, a small dividend, if you will, over the time period that loss is carrying over. The next couple of slides are more dealing with where most of the opportunity with tax planning arises outside of the retirement plan arena. So the next tip that I have is, to the extent that you have an employment opportunity currently that could be converted to 1099 income, either in part or entirely, or a lot of our clients also have locum tenens income on the side to a full-time job. Having 1099 income, if tax planning is done in conjunction with it, will most significantly allow you to reduce the amount of overall tax you pay. And again, without tax planning, the tax difference would be substantially the same. But with tax planning, you now move into the court of being now owning a business, and most of the tax law that we have involving tax planning strategies is around business income and sheltering business income. So one of the tips here, or the next tip, would be to the extent possible, convert W-2 income to 1099 income. If you already have a 1099 income, or once you have 1099 income, then to the extent that you can run that through an individually owned limited liability company, or in the state of California, it's got to be a corporation, then allows you to then elect for that LLC or corporation to be taxed as an S corporation. So Chris, go ahead and go to the next tip there on tip 6. If you use an S corporation in conjunction with running that 1099 income through an LLC, it's going to have a couple of benefits. One is you're going to be able to maximize your business write-offs by being able to do that, and then you also are able to set your W-2 salary at a much lower level. The IRS requires it to be a reasonable compensation. We have a software program subscription that allows us to calculate what a reasonable salary is based on the net income and other factors. And then one of the big reasons to convert 1099 income to an S corporation is, statistically speaking, it actually reduces the risk of an audit. Based on the most recent published statistics that the IRS has provided, generally speaking, if you have a Schedule C income of more than $250,000, you currently have about a 2.5% chance of an IRS audit. If you have that same income going through an S corporation, statistically that drops your audit risk down to a 0.7%. So a fairly significant drop in the risk of an audit, everything else being the same. On the next slide, I have another tip that once you have that 1099 income or it could be partnership income from a K-1, you might consider putting family members on payroll. Obviously, there's documentation that has to be created and needs to be age specific, duties and responsibilities as well as compensation. But what it allows you to do is shift income that you otherwise would be spending to support family members down by putting them on payroll, assigning certain responsibilities to them, and shifting income from being subject to your maximum bracket down to their tax bracket. And at least for the first $12,950 of income that they have, that would be at a 0% bracket. The next 10,000 is only taxed at about 10%. The other nice benefit is if you are paying these family members either out of a Schedule C or a partnership business, you do not have to pay self-employment or FICA and Medicare tax if those children are under the age of 18. So it's a double benefit because you don't have to pay your FICA and Medicare tax if you were to pay yourself that salary and then provide that financial support, but also by employing minor family members, you also not only get to shift that income down to their potential zero tax bracket, there's no FICA or Medicare tax that's owed on that as well. The next slide, I have another tip that is just around maximizing your home office. There's generally 3 acceptable ways to take advantage of your home office deduction. It's important to know what all 3 of those ways are, and then also so that you can make sure you get the most out of your home office. Since your vehicle would then be most likely used for business, you can also include the square footage of your garage, which is where you're storing your business vehicle. And then as it relates to maximizing your automobile deductions, there are a number of rules or tax rules out there, depending on how much you use it for business, on how much you can depreciate, and whether or not you are eligible for what is described as bonus depreciation, which is where you can take that full cost of that vehicle or the percentage of business use and expense that in the first year, if you want to. And then the 9th tip I'd like to leave you with is just to the extent that you are working longer shifts, generally that's defined as 12 hours or more, you might consider looking at the local per diem allowances for lodging and meals. Depending on if you live in a high cost of city or not, that could range anywhere from $202 currently up to $296 a day. So that's whether or not you sleep in the emergency room during shifts. You're still entitled to that per diem allowance, which could be in excess of what your actual out-of-pocket expenses. And then also be aware that starting July of this year, the IRS has increased the automobile allowance to now 62.5 cents a mile. So given the increase in inflation, that was just a recent change. And then the 10th tip I'd like to leave you with today is to the extent that you live in one of 29 states, over the last couple of years, each of those states have passed a legislation that allows a pass-through entity, so that includes an S corporation, a partnership type of entity, to pay to the extent that you pay your state individual income tax liability at the pass-through entity level, you're able to deduct that cost or that tax cost dollar for dollar, which if you don't do that, as you may be aware, And if you itemize your deductions, you're capped at $10,000 for both state property tax and individual income tax. So if you're otherwise subject to that 10% or that $10,000 ceiling, and if you have an S corporation or the ability to set up an S corporation or are a partner in a partnership, I definitely would, and you live in one of these 29 states, I definitely would recommend that you make that election. There are a couple of states that are considering passing that legislation, so you'll want to make sure that's in Iowa and Pennsylvania. They're contemplating it. Obviously, there's 9 states that don't have an income tax, so you wouldn't worry about it if you lived in one of those 9 states. And then there's only 10 states left, and again, this legislation is coming out almost on a every other month basis. So you want to watch this. But if you live in one of the states that hasn't yet adopted that legislation, just be on the watch to see if your state becomes one of those states, and then definitely talk to your tax planner about how to make the election, and then how to make sure you pay the tax at the entity level. And I wouldn't be doing my job if I didn't leave you with an extra bonus recommendation, and that is setting up a C corporation. Obviously, for now, that's where the tax rate is at 21%, and you can take advantage of fringe benefits. And then as a final slide, I'd like to leave you with is to the extent that you'd like to do tax planning, I recommend working with a certified tax coach who's also a CPA. And then the last slide I'll leave you with before opening it up for questions is if you'd like to check into the latest book that I mentioned earlier, you can download the first 2 chapters for free. Just type in or look at richestdoctor.com/bootcamp to read that, or you can go on the richestdoctor.com book and order the book yourself. Paperback is $4, hardback is $12. But we'd be happy to share that book with you. I think you'd learn a lot. And then if you'd like to move forward and have a consultation with us, on the last slide, I'll leave you with, there's a couple of ways to get started. One is to schedule an initial consultation with our client success manager, Angie O'Day. Her email is there. And if you want to take a picture of the UPC code there, or you could take a picture of that, and you could also move forward with requesting a blueprint. We do a strategic tax blueprint for all of our new clients. The cost is $1,250, but it comes with a 10 times guarantee, meaning that if we can't save 10 times that cost in the first year in taxes, the blueprint's free. So I hope this provided you with some value information. Chris, if we have enough time for any questions, I'd be happy to answer them.
Yeah, I think we have time for a couple. Thanks very much for the great presentation. So we have an audience question here that I wanted to ask. It's about conservation easements as a tax strategy. And the questioner is wondering if this is eventually going to be disallowed by Congress, and what your thoughts are on that.
So that was in President Biden's Green Book recommendation of limiting the value of that deduction. Basically, the most you're going to be able to save in taxes, and only if you're in the highest tax bracket, is you'll recover your initial investment. So there will no longer be a net tax gain available if that becomes law. I will say personally, I'm not a fan of conservation easements unless you're a rancher or a farmer and you happen to own the underlying real estate that would otherwise be eligible, but certainly not investing in a syndicated conservation easement. And the reason for that is onefold, and that is it's now considered a listed transaction, which basically puts it right on the radar screen of the IRS to possibly examine or audit that. And so right now the IRS is very keen on eliminating or challenging syndicated conservation easements. So I personally would stay away from them. I think there's plenty of other tax planning strategies out there that aren't under the microscope of the IRS.
One thing you had mentioned before about just making sure that physicians are working with a professional tax professional, an accountant. What should, in your opinion, as an accountant, what should physicians look for in sort of a financial services professional?
So it's probably more specific than just a financial professional. I would say it's probably somebody that has an extensive amount of additional training or credentials where they have gone through training to become knowledgeable about tax planning. So I have both education as a CPA and as a tax attorney, My recommendation or my experience has been that accountants are trained to put numbers on a return and do that over and over again and make sure they put the right number on the right line. They don't necessarily study the tax law. So it takes a lot of extra effort to understand the complexity of the tax law. Working with somebody who's proactive, I use the analogy or the metaphor of whether or not you want to be looking through there, or you have somebody that's looking through the rearview mirror of where you've been, helping you rewrite history every year, or you want to have somebody sitting in the front seat looking through the windshield of where you want to be and helping you come up with strategies on how to get there in the most efficient and tax minimized way.
Great. I think that's a great place to end it. We are about out of time. David, Physician Tax Solutions, thanks so much for the informative presentation. I really appreciate it.
My pleasure, and thank you.
So that's all the programming we have for today. On behalf of our Platinum sponsors and Medical Economics, I'd like to thank each of you for joining us. I hope you learned some great lessons and helpful ideas you can apply to your practice and your personal life right away. All of these sessions will be available to registrants free and on demand at medicaleconomics.com. We'll reach out soon when the materials are available. And I want to remind you, we have 2 more bootcamp events coming up this year on September 15th and November 17th. Learn more about them by clicking more trainings on the left side of the screen. Before we go, thanks again to our sponsors, Coach Care, Elation, MD VIP, Physician Tax Solutions, and Change Healthcare. Have a wonderful evening and a great holiday weekend. Thank you.